Welcome. You are listening to Purpose Driven Wealth, the podcast for empowered investors. If you're an investor who is tired of playing the Wall Street casino, stay tuned. On this show, we bring on industry experts to discuss leading strategies to help you make empowered decisions with your hard-earned capital. And now, here is your host, Mo Bina.
Welcome to Purpose Driven Wealth. I'm your host, Mo Bina. Today on the show, we have Chris Carsley. Chris has over 25 years of investment industry expertise in various areas such as corporate and venture finance, business valuation, portfolio management, arbitrage trading, and hedging. He is the Chief Investment Officer and Managing Partner of Kirkland Capital Group. Chris, welcome to the show.
Hey, Mo, thanks. And thanks for reminding me just how long I've been around. I'm trying to stay young.
You are very experienced for sure. Just for the sake of the listeners today, today's discussion with Chris is actually going to be a two-part series on performing due diligence of alternative investments. So there'll be a second part to this interview that we'll release at some point after this one goes live. But Chris, could you please kind of start us off by talking about your background and your experience working with alternative investments and performing due diligence?
Sure. Actually, I got my start dealing with just traditional investments. I was a money manager for roughly 8 years, just managing high net worth, small company money. Now, interestingly enough, sort of the first introduction to alternative investments and having to do analysis on things that weren't public related was you had a lot of clients come in with private holdings. And they needed share valuations. They needed assessments. So that was sort of my first intro of being thrown to the wolves of, hey, we don't know how you're going to value this or what we really need to do or where you're going to get your information from. Because you got to remember, when I first started, this will date me, a lot of your research was done through the newspaper and this cool invention called microfiche. So you literally had to sit there for hours going through microprint trying to find case studies or things like that could be used as proper valuation. So that was sort of my first intro, but got started in pure traditional. My specialty was derivatives. Just lucky, met the right person at the right time, got an opportunity to jump over and work for a hedge fund for a number of years. And obviously part of that job there again is you're running a series of trade books. And some of this was event-driven arbitrage. And you have to come up with your own trades. And as we were talking before the show, Mo, there's due diligence has a lot of names. It's underwriting, it's securities analysis. I mean, you're basically doing research to determine, some number of factors so that you can make an educated, based investment. And so as I was joining the hedge fund, you now had to put together entire trades end to end. And it was a different kind of due diligence as you're walking through something that hasn't been built yet. You're the one building it. You're going to see if you can actually make money doing this trade. And then after working for a hedge fund, that was back on East Coast, came back, spent most of my time West Coast, had an opportunity to join a great group right here in Washington at a fund of fund. And then it switched into where I really went full bore into what most of what we'll talk about today, and what I think most people are thinking this discussion is going to be about, is the due diligence of alternative investments, primarily funds. So we worked at a large fund of fund. We invested in a number of different esoteric, special situation trades, hedge funds, covering a variety of different strategies. So you had to come up the curve on a lot of different types of investments. And we'll talk a little bit about that later, because that's just one piece of due diligence. One of the other tasks I had at the fund of fund, because this was 2000, into 2007 and into 2008. So things were just about to get really, really interesting. We didn't know it at that time, but this shop was one of the things they brought me into, is to build an entire operational due diligence program. So I did that for them as well. They had a top-notch ability to understand the investments, but they needed to dive in a little bit more on the operational and business side of due diligence. So that's one of the things that I built for the fund of funds. So that really gave me a lot of iterations to look at a lot of different structures in due diligence. And then after the fund of funds, I went out and did a number of things. on the venture and startup side. So there again, a little different way to think about analysis as you're trying to build a company from scratch, and you're putting everything together to understand, market, what's going to be your, go-to-market plan, how that company is going to efficiently run that. And it made sense because most of the thought process you're going to was very similar to other due diligence I had actually already done, but it did give me a different way to look at things. So I was invited in the room because I didn't have a traditional startup or venture background. So they're like, oh, let's bring the guy in who, didn't come from venture, but he's looking at things differently. So some of the teams I worked with, they recognized I was going to, have a differentiated view. So if you're ever putting together a due diligence team, don't put a team of people who all think the same. You want some differentiated thought. And then after running a small seed angel fund and working in that space, I was then approached by my now partner, Brock Freeman, in 2019. And then we launched a private debt fund in commercial real estate, which I'm still running to this day.
When you were talking about when you were working as your previous role, working and investing in fund to funds, were those funds primarily like very specialized, or were they or some of the funds investing in very kind of broad assets? Because it seems like the amount of due diligence you would have to perform in order to invest in a fund that's kind of investing in various types of assets versus one that's more specialized probably takes a lot more work, right?
Oh yeah, no, if you're going to look down and I'll put a word to it, it's really a single trade type fund versus a multi-strat. A multi-strat is a lot of work, and you really need to break down the attribution of all the different types of trades they're doing and really understand how they're controlling their portfolio, because you're looking at one company and one operating team. So that saves some work. But from the investment standpoint, you could look at 8 or 9 different silos of actual investment theory. So yeah, you're right. I mean, if you're looking at somebody who has a lot of tricks in their bag, it's a lot of work. Rather than someone who's like, hey, I'm a muni bond trader, or I do, relative value arbitrage in Asia. I mean, you could, okay, now I'm only looking at one sort of sector. I really just have to understand the risk profiles and what's occurring in that one trade. So yeah, I mean, it's a lot of work. So, if you're out there doing due diligence on a fund and you run into somebody, whether it's real estate or hedge funds or anything else, and they've got a lot of things they can do, they've got a lot of style flexibility, you got a lot of work in front of you. I'm not going to lie. It's, I may be the lead on some of that due diligence, but at the institutional level, you're not out there by yourself. I mean, you got a team. You're not running end to end. You may be in charge of running that particular fund's due diligence, but at the fund to fund, we had 9 people. You had a lot of peer review, which, I mean, one of the things that if we run into that question, we can circle back to some of the problems that I think people are having in today's world is, hey, it's just me investing my dollars. I don't have a team. Where do I find peer review? It's a problem.
Yeah, and that's actually a good point. Let's kind of make a mental note of that and circle back with that either in this discussion or when we do part 2.
Sure.
Because investors, retail investors, or someone who's just kind of investing on behalf of themselves or their family, they're going to run into that situation. So let's circle back to that. That's a great.
Yeah, you're a doctor all day. I mean, and then all of a sudden you got to put on a whole another hat and do due diligence on a fund. Well, I mean, how many hours do you have to actually effectively pull that off? And there's some ways you can organize your thought to help you achieve that as a sort of a single person doing due diligence. But yeah, we can definitely circle back.
Yeah. Since today's topic is about due diligence of alternative investments, perhaps we should define, what are alternative investments and what are the major types out there?
Oh gosh, do we have enough time? I always tell people it's easier to define what an alternative investment is by telling you what it isn't. In a broad scale, everything that's traditional long stock, long bond, maybe what your financial advisor is putting together for you, that's your traditional side. Anything else is really alternative, and there's some gray areas depending on who you talk to of what's alternative, but you've got hedge funds, venture. I mean, which venture is sort of, if you want to talk broad categories, private equity. So private equity comes in a variety of different forms: buyout, large private equity, down to venture. Maybe you're, early on the curve, you want to do angel and seed investing. So that's all kind of that view under private equity. And then you've got real estate. You can do direct real estate. You can do equity or debt. There's a lot of different ways to even approach real estate. And then you've got hedge funds. Last time I counted, there's 26 different kinds of hedge funds. Some of the biggest are like your convert arbs, your merger arb, relative value. Like we'd mentioned earlier, there's a number of multi-strat, and probably the biggest out there that I think there's like 7,000 of them that exist just in North America is the long short equity. There's lots of ways to play long short equity. I'm not sure that there's a need for 7,000 of them, but it's I was told by my manager at the hedge fund I worked at is the world doesn't need another fund. If you're going to do something, try to create something that's not done by 50 other people. Easier said than done sometimes, but yeah, lots of different, and in that gray area, I hear some people sort of say, okay, well, are REITs really an alternative? And I know some people you'll run into, they talk about them as alternatives because they do focus on real estate. But I would say no, and that's just my opinion, because of the nature that they are public REITs is what I'm going to talk about. Is public REITs really don't act like an alternative because they actually have some pretty high correlation to other public markets. The last time I was looking at like MSCI REIT correlation to S&P 500 was like 0.88. I mean, it's a huge correlation. They tend to move in lockstep. So, and one of the things when you're looking at alternatives is you're either looking for, hey, can I enhance a return or am I reducing a risk? What is this alternative doing for me? And I kind of view that, and that's sort of my reason why I don't sort of put public REITs in the alt spaces. You're taking on a different risk factor of getting a variety of different real estate exposure, but you're not really reducing any risk. You're taking a risk factor that is very similar to what you would get in just a public market investment.
Yeah, you kind of touched upon. Oh, sorry. Go ahead.
Go ahead. Yeah, no, go ahead.
No, I was just going to ask a follow-up question. You kind of mentioned about, one of the reasons, or two of the reasons, I guess, why people primarily look at alts is enhancing a return or reducing risk. Are there any other advantages in terms of trying to include alternative investments within one's investment portfolio, other than those two?
Those are the two I focus on, because then I think any other derivatives sort of fall under those two broad categories. And you can break it down into a lot of people, especially, recently in 2022, there was a big push and a lot of people sort of going after, how do I add alts on the equity side? It seemed to be the biggest bang for the buck. And most what people were going there was they were trying to enhance a return because they were thinking, hey, public equities are not going to actually have the return that I might see in private equities. And there's a lot of math, and a lot of the institutions have data on this, where generally, private equity does outperform public equity over time. And so there was a big push for people to try, because they were realizing, wait, am I going to be able, if you're a large pension or endowment, you have a certain amount of liquidity you need to make sure you're maintaining a certain return, and you got to have that required return. And they were looking at a situation that they might fall below required return if public equity was not going to enter the return. So there's a very big push into private equity. But one thing that 2022 brought to light was also, it was the worst performing year for fixed income. And fixed income is a little boring. It's not very exciting. No one goes over to their neighbor's house and drinks champagne and brags about their fixed income fund. I mean, it's just not, no one does that. I mean, but you do have the opportunity where in the alt space, you can have actually some interesting bragging rights, because there is a number of instruments out there in private debt that actually do have the capability to generate a nice excess return, and really truly create an equity like return with debt level debt. or debt level risk. And so you might have some bragging in fixed income. Who knows? Depends on what your portfolio looks like. But yeah, to answer your question, that shift in one way or another was people were either trying to capture a greater return, or they're looking and saying, wait a second, can I maintain a return or capture a return that wasn't prevalent in fixed income, yet I can still have the diversification factor? Because that was the big problem with fixed income, is it's supposed to be a diversifier. It's supposed to be that, hey, lower the overall volatility of my portfolio, so that interim liquidity I need, I don't need to pull from equity, I can pull it from fixed income if needed. Well, that kind of all disappeared when you're down 14% on your fixed income portfolio. It really got everyone's attention of, wait a second, can I actually, add alts to mitigate risk? And a lot of people don't think about that. And I laugh because I talk to a lot of people on the retail side. They think, hey, I'm going into hedge funds, and so I really want to crank out this really big return. And I'm like, okay, the word hedge does not actually mean massive 50% return. I mean, there are speculation funds that, yeah, they will do that, and they might fall under the category of hedge. But a true hedge fund is really trying to just target the best risk-adjusted return they can create. Keyword risk adjusted. They are trying to control risk. They are hedging pieces of their portfolio to limit that volatility. And if they're effective at doing that, you usually don't see these massive outsized returns of, big double digits that people kind of expect hedge funds to do. True hedge funds really have an amazing risk mitigator on a portfolio if deployed correctly.
Mm-hmm. Yeah, it totally makes sense. What are some of the disadvantages or potential disadvantages when investing in alternatives?
Yeah, and you've got to. I always tell investors, you got to understand what's your liquidity requirements, understand your suitability, because if you're going to go into alts, one of the biggest things that usually people complain about, and it varies between which alt category you're in, is liquidity. A lot of these investments are capturing excess returns because they're in an investment that requires some level of illiquidity. I mean, one of the best that people are looking at and trying to solve right now is venture and private equity. You got this whole 7 to 15 year time period. Well, I mean, that might work for a part of your portfolio, but you got to size that correctly, depending on, the restraints in your own portfolio. If you have a high liquidity need, well, then that's not going to be an investment you want to oversize. And I know a ton of people who ran into that problem in 08 and 09. They thought they had enough going on, and they went into 5-year investments, and the world turned upside down and they needed their cash. And you're like, well, you're not getting it for a while. If it's, actually still even there. So that's one of the big things is, you've got liquidity issues. The other one is, I think a lot of people go in and they don't really understand the nature of the trade and the risks they're actually exposed to. Some of these trades and some of these alternatives can be quite complex. And I generally tell people, if you ask a manager, what do you do and how are you generating this excess return? What's your inefficiency? What's your edge? If you can't get clear, understandable answers and you walk away from the table after asking that, you still don't know what that manager is doing, or it just had so many legs to what they're, maybe that's not the right trade for you. Maybe you should just kind of walk away or spend more time trying to educate yourself on what that trade is. And I've run into those. I mean, I work in this industry. I was a trader, and I have sat in front of people and they explain to me what they're doing. And I'm like, I'm not an idiot, and I have no idea what you said. I mean, I've literally said that to a manager. I'm like, you're going to have to walk me through actual trades. And of course they didn't want to do that. And well, we didn't write a check. So that's one of the other problems I run in, or I see for people looking to go into alts, is really, really find something you can understand and understand the risks you're taking for your portfolio. I mean, understand how the trade breaks. And if the manager can't explain it to you, or they tell you something like, oh, this always works. Yeah, nothing always works. There's no holy grail. I've tried to find it for a long time, and I know other people who've tried to find it. Something always breaks a trade. We, in the relative value sort of event-driven trades that we did for years, we used to sit back, put our feet up on the table and say, hey, you know what? Nothing can possibly, cause us to lose money unless a major global financial partner goes out of business. That's the only thing that can, and that's never going to happen. Yeah, we were talking about this in like 07 and early 08, and well, we were wrong, and we saw our trade break. Even as absurd as everyone thought that was, it happened.
Yeah, I like your the question that you kind of posed too is, just boil it down as simply as, what is your edge? What type of inefficiency out there are you taking advantage of, or planning on taking advantage of? And you're right, if they can't articulate that in a very kind of simple way, then, and it's very complicated, there's a lot of moving parts, then that in itself, I guess, makes it more risk prone, right? Because there's a lot more moving parts, more things potentially to go wrong with the trade, or a particular type of asset, or whatever it is that they're trying to do. And that in itself, I guess, is just a really great kind of due diligence question to maybe pose, or to even think about when someone's doing their research, or doing their, I guess, underwriting, or whatever phrase or whatever industry you're in, where they basically are researching and trying to find the merits of an investment.
Oh yeah, you'll there's a continuous theme you'll hear from me, no matter what I'm talking about. But if it's in investments, is inefficiency and edge, because you can't create an excess return without some level of inefficiency that's sustainable and repeatable. And here's the other, I guess, I don't want to call them negatives, they're just challenges of alts. Is it's not just about the investments. It's the due diligence is actually much deeper, because you are investing in a company. At the end of the day, you may think, oh, I'm investing in a fund that's doing this investment. Okay, well, who runs that? You got the manager. That's the company you're invested in as well. You're invested in that manager, and that's that edge part. And that's where I think a lot of people, they do the investment research and they go really heavy on that, because one, that's the far more interesting part. But the other problem is then they kind of stop, or they go super light on the operational side, and they don't dive into the other exposure and risks they're taking. Is they have a risk and exposure to the team that's managing the fund. And what most people have maybe heard or have not heard, most failures actually occur in the operational side, not actually the investment side. About 66% of fund failures is operational mistakes, team mistakes.
Interesting.
Not actually in the investments.
So it sounds like you're now getting into kind of the different types of due diligence. Can you kind of maybe take a step back and kind of define what are the major categories or areas of due diligence, and maybe a little bit about each one of those areas?
Yeah, I break it down into four pieces. One, the most exciting and what everyone loves to do, is the investment due diligence, diving in and understanding the nuances of this amazing trade that's going to generate excess returns. It's super exciting. That's where people tend to spend most of their time. But moving on, as I just said, there's a lot of other important aspects that, investors new to alts are going to have to think about. One of the big ones is the operational due diligence side. Now, the definition of operational due diligence is anything operationally at the manager or at the fund that directly relates to the trade. So that can be, well, who's your traders, allocation policies, down to cash controls. I mean, a number of different things fall into operational due diligence. Next is business due diligence. Now that sounds like, well, what's the difference between operations and business? Well, business is more the operations around running the actual business that don't have anything to do with the trade. So it could be like facilities, security systems and software, things like that. So how do they build their business? And how does that increase the efficiency or secure the operations of the fund? But it doesn't have anything to do with the actual trade. So, in the early days when we were sitting around with AIMA and everybody else in 2009, trying to figure out what the new world of due diligence was going to look like, they didn't have business separated out. They just kind of shoved it all into operational. But more recently, people have realized, wait a second, with cybersecurity issues and a number of other things, it's kind of becoming its own class. And it's actually pretty large and pretty important, and requires a different number of skill sets to, complete that level of due diligence. And lastly, is, economic due diligence. After you understand the trade and you understand what breaks it, one of the things that you might want to understand is, well, is there a cyclicality to the trade? When does this perform well? When does it perform poorly. And then you're doing some level of economic assessment of like, well, is this the right time to think about this trade? Is this, is everything breaking because we've got rising interest rates and this trade doesn't do well in the rising interest rates? I mean, these are the kinds of things you need to start thinking about of, well, what is and I'll use a term here, the macro events that are occurring. They're not directly related to the trade or the fund, but there are events that can definitely affect, the company's operations. Well, I'll give you one example there is you use a leverage line. Well, if leverage is hard to get and free capital dries up and someone calls in your leverage line, well, okay, you now have an operational problem. Depending on how much leverage you're using, you could be in a situation where you've got to start selling things in your portfolio or find someone else to, finance it for you that might cost more. So now the return to the investors is lower because it's a tighter spread between the cost of leverage and, the actual return on the trade. There could be a number of problems. And then obviously there's things, in the macro world that can affect, the direct investments as well.
When I was thinking about your kind of examples you were giving with the economic, in my mind, I've always kind of articulated and kind of like combined that with the actual investment itself. But I can see why you probably want to separate and kind of like have it on its own. I guess with the investment, that is specifically just the investment itself. But with the economic, you're kind of looking at the more broader global macro picture of how that investment fits with what's going on a kind of bigger picture level, right?
Yeah, bigger picture. And there again, no one really, you're dating yourself because economic was really embedded mostly in investment, but they realized there were actual economic occurrences that could affect the business as well. So they're kind of like, hey, let's make it our own section and really understand these macro events. How could they affect the manager, the fund, and the investments?
Yeah, that makes sense. When you were talking about kind of the operational stuff as well, too, in your experience, did you run into situations where fund managers and you probably know, I could see you smiling, you know where I'm going to go with this, where they probably were very guarded or perhaps didn't want to share operational type information? And what do you do in that case? Do you just kind of walk away and say, well, if they're not willing to be transparent, then we're not willing to invest or move forward? And how do you kind of deal with that? Or even for like, I know I'm kind of asking a number of different things now. How about a retail investor? If they're doing that operational due diligence and they run into roadblocks or they run into managers that don't want to share information and basically say, well, that's our proprietary intellectual property and we can't share that with you. Have these things come up in your experience and have you kind of dealt with them?
I have don't necessarily use this, but I have said this to many managers. If you can't disclose what I'm asking, then it means you don't actually really have a defensible trade. And if you think I can actually learn whatever you're doing operationally or investment wise and reverse engineer you in one conversation, then I'm not writing you a check anyways. I need an inefficient trade that I see sustainability and repeatability to where there's some level of moat, some level of difficulty. Because if everyone can just step into your trade and it's that easy to understand, then I'm going to be here for a very short period of time. And I'm not really actually sure when the break will occur. And my ongoing monitoring becomes extremely intensive. So one thing that we've kind of not really talked about is everyone does a ton of due diligence up front. And if you ask anybody who's in the due diligence business, is yeah, that's a lot of work, but it's equally as much work for the ongoing monitoring. So you need to stay on what's happening. And if these funds have certain level of allowable drift, or sometimes they don't, you've got to watch style drift, where all of a sudden the trade they said they were doing is not working. And then you wake up a year later and you look in and you're like, what are you doing? You're doing a completely different trade. That's not what I invested in. That's not what I assumed was right for my portfolio. And unfortunately, we ran into some of that style drift. When it was too late. Some of the funds that we had invested in had massive style drift. And when 08 hit and we kind of like took a deeper dive, well, we're wondering, how in the world did you guys lose money? You shouldn't have lost this kind of money. And you realize they were actually doing something different than what you thought they were. I've run into a lot of people that usually not so much on the operational side. You will run into some people like compliance manuals and things like that. And that's not really a retail level, but from an institutional level, if I visit your office, I'm going to be there for 4 to 8 hours. I'm there for the day. And pretty much every document you have that pertains to the operations of your fund, I'm going to read it. And so some people did run into problems where people walked away with certain documentation and turned around to use documentation in a lawsuit against them. And so now you have a lot of funds that won't let you walk away with things. You can review it while you're sitting there if that's what you want to do. And some of these documents, 80, 100 pages. I mean, you better read quick. You better know what you're looking for, because otherwise it's going to be a multi-day on-site verification. From a retail standpoint, and yeah, I don't want to go too far into this because there's a number of things that you can kind of do to help guide you in this huge process. But I've had people are like, oh, I can't show you certain software. A lot of people on the quant side, if they truly have like a black box that's got some unique programming, and if you want to invest in that fund and they can't really tell you what it is because that's their proprietary tech, as an investor, you just got to be comfortable with, well, do I trust that person? And do I trust what they're doing? And in other ways, you can kind of, or don't, and just walk away. If you need full transparency in every moving piece and you can't get it, you walk. There's no lack of investment opportunities out there. And someone says, oh, there's no one doing, I was just reading a website and it was really funny because people always say, we're the only ones that do this. Okay. Really? The world's a very big place. I've never seen anybody doing something that someone else isn't doing in one form or another. There's always somebody competing. I mean, even in the space that I'm working in with our debt fund, it's small, it's niche. And we don't run into a lot of people that do it consistently, but there are people that come in and out of it. I mean, so there is competition. But as an investor, and we used to do this all the time. I mean, there's a very, very famous fund now. We'll leave names out of it because it's a small world. I sat down when they were just getting started and we were going to be one of the first checks. And one of the things is I have to sit on your trade floor and walk through what I call the life of a trade. Walk me through how you came up with the idea, how you executed the idea, how you monitor that particular position in your portfolio, and the exit. And why you made the exit decision. Or if you haven't made an exit decision, what's your assessment of when you think you're going to exit? What's your target exit? And so I would sit and I would pick a trade randomly. I wouldn't let you pick a trade or like, oh, hey, look at my deck and here's a trade that I did. That can be gamified. I need to sit down. Here's your book. These are all the things. Now point to the screen. What about that one? Let's talk about that trade. And I had a fund that was like, well, no one sits on our trade desk. And I'll be honest with you, I was like, okay, thanks for the coffee. Appreciate the donut. Started packing up my papers. And they looked at me like, well, what? And I go, meeting's over. If I don't get the transparency, and you got to remember, I worked at a fairly large shop. So when I'm going to write a check for you, it's not some $100,000 check. It's, I'm writing a $25 million check. So it's kind of one of those where, it's material, what I'm about to do. So, and they were like, well, wait a second. Let me ask around. Let me check. And so after about 20 minutes of them getting authorizations, I went and spent about an hour and a half with the traders on their trading desk and got to walk through a few trades. And we ended up making an investment. It was a great investment because it was a great fund. But that's not always going to happen. When you're a retail investor, you're not writing $25 million checks. And so you might get a lot of pushback. And in my opinion, I'd walk. If you just can't get what you feel comfortable with, you'll find something else.
Yeah, exactly. Other than having a team, which you've alluded to, being able to sit down for 4 to 8 hours or more at the hedge funds or the funds offices, in your experience, how do institutional level investment firms perform or approach due diligence differently than retail investors?
Well, you stole some of my thunder there because that's really some of the bigger differences is they'll have institution guys, everyone's got a checklist, and I'm a fan of checklists, and I'm not a fan of checklists. It depends on how you want to use it. Organize your thoughts, because there's a lot to cover. And institutions will have a very, very thorough checklist, but at every checklist spot of something that can be verified, the institutions would take the time, whether it's on site or a request for materials ahead of time. And, our checklists were always two boxes for every line item, not one box. It wasn't, I asked you a question of, do you have, cash controls? Yes, we do. Check. Okay. What did I didn't do anything. I asked you a question and you said yes. That's checking boxes. That's not actually achieving any type of due diligence. The second box is great. Now that you've answered yes, let's walk through exactly the process and procedure in your process and procedure manual, or you go show me how it's done. And I can't say this for all institutions, because I did have people come in and do due diligence on us. And I ran all the futures trading, a lot of hedging and, creating a synthetic exposure for clients that wanted it. And I sat with one group that, they had a fair amount of money with us, and they asked, oh, you run trading. And I gave them this short little spiel about what I do in futures. And they literally, I kid you not, checked the box and moved on to the next question. And I kind of was like, well, we're trying to get more money out of you. I was like, well, do you want to go to my computer and I can actually show it to you? And the guy looked at me like, no, that's not necessary. I was like, I'm literally trying to help you do your due diligence better. And the guy was saying no. So my point being there is, don't be that guy checking a box and just moving on. If you ask a question that you think, hey, whatever it is really important, how are you going to verify it? And understand how you can verify those ahead of time. And if you got questions like, hey, I love this question, I'm not really sure how to verify that. Great. Ask a question, put a question in the bio. After you watch this video, reach out to me and I'll see if I can come up with what I've done. Or if I don't have an answer, I'll reach out to other people who are still working for major billion-dollar funds, allocating to hedge funds and wherever, and say, how do you guys verify that question? And I'll get the answer. But that's the thing you got to do is that, and that's what the institutions, most of the big institutions, they will take that extra step. Now, as you alluded earlier, and we talked about, the big difference is they have teams, resources, software. They have so many things that help them achieve due diligence en masse. Because you got to remember, I'm not looking at one or two funds. I'm looking at 100, 200 a year. You're going through a ton of different, that's your job. And so, as a retail investor, I wouldn't try to boil the ocean. Identify what you want in your portfolio, go after that sector, get the education you need, identify what the important factors are, which I actually call, there's two levels to that. There's non-negotiables, and then, oh, hey, what do I actually need to verify? Investment wise, operationally wise, business wise, and and then obviously the economic side of it's, that due diligence purely on you. And you can ask the fund manager about when they've performed and what the risks are in different economies, which I think is a great question. But a lot of that research kind of lands on you and your opinions. So that's the biggest difference. The institutional side is extremely procedural. They've already mapped it all out. And they have people and systems that are trained to carry that procedure out like clockwork.
When you were talking earlier about the ongoing due diligence that you and your team would do, and then you kind of mentioned drift. So what would you do when you experience drift? Because at that point, have you not already mobilized capital? You've already made your investment. And what recourse do you have at that point, other than to tell a fund manager or tell a management team, hey, you're doing something differently than what you told us, or what was in your procedure manual or whatever, but you've already made that investment. What would be, I guess somebody may listen to this and wonder, well, what's the point of doing ongoing due diligence? You've already given them your money.
Depends on the liquidity of the fund. If you've got something that's got quarterly liquidity and they're not doing what you want anymore, redeem. If you've got something that's got like a hey, I'll get your money back to when the deal comes due, something like in venture, where that could be there's not a lot you can do to create liquidity in the situation. You can certainly cause a ruckus of point out the fact that, hey, these guys said they were doing AI tech and now we're doing consumer good.
Yeah.
It's like, whoa. And then you probably actually have a breach of contract, depending on how they wrote their document. There might be a lawsuit to create liquidity if they've just gone off the cliff, and it's a lockup. There could be a number of things to take from that standpoint. But you're correct. You're not able to just get out tomorrow once your manager is doing something you don't like. And one of those things is, this gets down to also read your documents, because most managers, at least the good ones, they've built some level of flexibility into their PPMs and their documents that allow them some level of movement. And it may not be something that you like as an investor, but it's maybe they see an opportunity set, or they think it's a better risk adjusted return for the portfolio given a current change. And that's something you'll have to assess at that time. And, before you go cry wolf, really make sure you understand the PPM and the operations of the fund to understand what type of drift they can have. Because I haven't run into it, but I know other people that were complaining about some stuff in more tumultuous left tail event type times. And it was right there in the PPM that they could do those trades. And so it's like, well, okay, you just didn't read your documents.
I guess this also kind of ties into when we're talking about one of the disadvantages of alternatives and private investments is the liquidity aspect, right? And so when if you have your money into or invested in a 7 to 15-year hold period, and you've already mobilized capital, this is kind of one of those potential disadvantages that investors, I guess, should be aware of, because once you mobilize that money, even with doing ongoing due diligence, you may be very limited, or you may have no ability really to do anything if the fund or its strategy, is drifting from where you thought or where you were told it would be.
And that's definitely, and one of the things also, there's some recent articles about the reemergence of zombie funds. So this is a zombie fund is basically, you've got a private equity level fund that has a number of assets, or portfolio companies that are being held that aren't performing, and you've got money locked into them, and they're not really performing well, but they're not dying. So your money is locked up. You have no access to liquidity. You can't get your money out, but they haven't really breached anything. So you're just stuck. And so, yeah, the CAIA and a couple other guys did some research of just current data of what's going on, in the private equity space. And they're seeing a lot of the factors that created, zombie funds. So they're like, well, we might be coming into an era where we've got a lot of private equity funds that you're going to be in them a lot longer than you think.
Or you could have a situation where it's lost money, but you can't take a loss and realize that loss for tax harvesting, or to offset maybe gains in other parts of your portfolio. And so essentially there probably is a loss that you can't realize because somehow or other the fund just keeps going, right? It's just
correct.
It can be technically dead, but it's still kind of still moving forward.
You can definitely get locked up into a number of different occurrences, which is, where I go back and I say, well, before you start your due diligence is really understanding what is it you want to add to your portfolio and why, and then really be honest with yourself about the sizing. Of, hey, if this occurs, it's not 80% of my portfolio, it's 10, whatever. You got to understand the risk factors and size accordingly to what you think you want to achieve. And these are all different for every individual. Your objectives and constraints are different than mine, and and different from someone else's. So there's no real, oh, this is what you should do. This is how you should size things. This is the amount of alts you should have. Well, that's different for every single person. And I've actually had that question. Well, how many alts should I have? I'm like, okay, I'm not really your financial advisor. I mean, it's a great question, but that's a question you have to ask for yourself. And you got to build that and understand that as you're building out your portfolio and looking at alts. You should do that before you put your feet in the water.
Yeah, I totally agree. Chris, from your experience, what are some recurring red flags that arise when you're performing due diligence?
Yeah, recurring red flags. I always say follow the money. So cash controls. I know this really is a scary idea in today's world, or people may not understand this, how it goes on, and it may be common in smaller funds. But pre-08, I would go visit some funds, and they had a special computer in a room that was just on, and it was a computer dedicated to wiring funds, and anybody could sit down and wire money. I know it sounds ludicrous, but pre-08, well, it was efficient. Hey, we got to wire funds. We got to do this. Okay, so this guy goes over here, and there was a reason for wiring funds on multiple different aspects across trading desks. So you have these larger hedge funds, and it definitely created efficiency, but it also created a huge open gap of wait a second. You've got a team of people who can just sit at this computer and it's always on. I don't think anybody's doing that today, but what I'm getting at is, are there dual cash controls? Who actually has authorization to move money? And walk me through various occurrences of, how things are moved between the fund and the manager. How are things moved from the fund to external? Walk me through those pieces. So cash controls is a big red flag. Even in the latest situation with, the Nightingale people, it's like money came into an account and then in short order, it was moved out, but it was not supposed to be moved out to the actual manager. It was like, okay, wait a second. Who breached cash controls there? So if you had a procedure, and I'm not saying they did, I have not read through the documents or anything else, but I was just reading the article about, wait a second, money went into CrowdStreet and then it got moved out. And it wasn't supposed to, and it was said that wasn't supposed to happen. Well, that's one of those things where cash control. It's like, well, listen, as an investor, what's your biggest concern? I'm losing my money. Well, losing your money doesn't actually always just happen in the investment side. I can also just move it off somewhere where it's not supposed to be. And I know that sounds ludicrous, but it literally just happened. It happens all the time. This one just happened to be, in the front page of the news. So cash controls, huge red flag. Third-party oversight, another huge. And this is one where, who's looking over the shoulder of the manager? Who's watching things that is not part of the company? Who's monitoring transactions? Who's maybe calculating management fees? Who's, doing external books and records? There's a number of third-party companies. One of the biggest ones that the things that I listed there is kind of a fund administrator. Do you have a third-party fund administrator in place, and what do they do, and how do they integrate, and what's the check and balance there? And there's actually a variety of different checks and balances where, even to make a wire occur, I've seen some funds that it's not just, say you and I run a fund, you got to have your signature, my signature. Well, the third party's actually got to have a play in that too. Now, if you're high volatility, you can't have a third party involved. It just, you won't be able to get your done if you got low latency trading and things like that. But if you've got infrequent trades, I've seen some people, writing big checks. They want that third party approval also of, hey, I've got documentation. I've collected all the documentation. I've got all the authorizations. I've double checked wire details, and now I can sign. Okay, great. It's moving to the right place. Everyone has checked off it's moving to the right place, and we've got all the supporting documentation in place. Smaller funds, maybe won't see that level of controls, but they should be on some path where there's third-party oversight. Another one is valuations. Always a big red flag. There's tons of SEC indictments and everything else that deal with, people running their own valuations, and I'm not talking, and for people who don't know this, there's different tiers of valuation. in the more esoteric non-public instruments that are not valued every single day. That's where there's either a third-party valuation or some very, very defined process that is explained in nauseating detail in the PPM of how it's run, maybe in conjunction with a third party and internal. And I'm not saying it's wrong. And sometimes you'll have people run valuations just internally. I'm not necessarily saying anything's wrong. That's not fraudulent or anything else, but that's something you got to dive in on then. That's okay. Wait, you're valuing everything inside the manager. Okay. Well, there's a lot of potential conflicts of interest by you having that kind of control and power. Great. I can value something really big so that, when you come in, you're getting, if they do a unit base or something like that. Okay, great. You're getting, less percentage because it was, or, oh, wait, you're getting out. Oh, this is really low value. So I'm going to send you less money. I mean, there's lots of little things people can do from an accounting gamification standpoint and valuation. I'm going to charge my fees. Well, everything's worth a ton. So I'm going to crystallize and charge my fees. I mean, I know this sounds like I'm giving like some ridiculous scenarios, but this stuff has actually happened in the real world. So valuations is a red flag. We talked about it earlier. Transparency, the ability to obtain transparency. If you can't get transparency, that's a problem. I mean, that's a pretty big one in today's world. And I will say this, not especially in hedge fund space, there is some esoteric trade structures that really, if I told you how I'm doing it, it's like letting the cat out of the bag. Depending on who you are, you could go do it. I did some of those trades when I was, working for Paloma, and the value of your trade went down as soon as the information was out, and all of a sudden the prop desk, Goldman, Morgan, all these guys are coming in and taking your trade. So here I am making $7 million 1 year, and now I'm barely making 100,000 on the same trade 2 years later. And that happens. I mean, there are trades where there's very limited barrier of entry, and it's an intelligence and network thing, and you got to keep it pretty quiet. So if someone's like, hey, I really can't tell you how I'm doing this, identify and understand the nuances of how the trade works, and maybe that transparency is something legitimate. They can't give it to you. But in general, you should be able to achieve transparency. That's another one that we've seen. If someone can't introduce you to something, or somebody can't share information, you got to really think to yourself, I now have a dark hole that I can't check any boxes or do any verification. And I'll tell you, one of the biggest losses I ever had was 49 stars, all perfect, verification, all perfect, one box left open. And I made the trade anyways, because I was like, okay, guy seems smart. And that actually broke the trade. That one box, my inability to understand that one factor and get that was the breach. And yeah, I lost money. So I'm pretty draconian of where, if you can't answer things, and I feel like there's an important piece to the trade that I can't verify, and I have a nice day. I won't do it again. It's kind of one of those, I'm a once bitten, shy immediately. So, and then, the other one that I see also, that everyone thinks if I go with a really large platform, or I go with, some big name, something can't go wrong. Things can go wrong anywhere. Don't get sucked into the big guy running $1 billion is somehow, better than maybe the mid-sized or smaller guy. You still got to do your due diligence. You still got to understand all the moving pieces. And, I've been co-writing some different papers about red flags in due diligence with a friend of mine, who John Canaro. And you'd be amazed, almost all the SEC indictments are these major big funds that have breached all kinds of things. So that's one of the things I also, is like, I tell people, it's like, I don't know, it's not a red flag but don't get swayed by the, I should always just go to the big name, because somehow that'll be safer. Maybe, but not always.
Yeah, that's a good point. Yeah, these are all the red flags you identified. These are all great ones for people to kind of keep in mind, especially especially if whether you're institutional or retail level investors.
There's more, but We could go on and on. I mean, I've got an 8-paper series that we're busy writing, and it just, you got in all kinds of nuances that get pretty institutional, like structure of investment allocation. Okay, what that means is you're investing with somebody who's got multiple funds. Okay, well, who gets the trade out of all the funds? And how are the trades allocated between the various funds, especially if they have overlaps? It's very common, very common structure. And you see a lot of problems in very large shops that run multiple funds that have overlap in trade style. So certain funds with certain clients that are not you are getting the better trades. I mean, here again, sounds ludicrous that anybody would purposely do that. Go read my last paper that I posted on the CAIA blog, and there's an actual SEC indictment that we actually cite because it's public information, where a UK-based fund manager did exactly that. He literally took all the best trades and put it in a fund for large premier clients and the employees and partners of the fund, and then created a sub fund for all his investors that really invested after they had already made their investments. So you got an investment allocation problem, and you also have a front running problem.
Wow, interesting.
I mean, that's a real trade. So you can go to the CAIA and you can .org and you can look up that paper. It's a pretty, like I said, it sounds like, wow, that would never happen. Why would someone purposely do that? And happens all the time.
Yeah. Well, in our next discussion, we'll get into take a deeper dive into due diligence, and we'll kind of get into the weeds more than we did in this discussion. But until that next discussion, that next interview that we do, Chris, how can people find out more about you and also Kirkland Capital Group?
Yeah, certainly. Obviously, you can go to our website, kirklandcapitalgroup.com. You can, find information about the fund there. You can, set up meetings, whatever you want it to do. For me directly, if, you just want to talk more about due diligence or alts or whatever, you can find me on LinkedIn. I'm the only Chris Carsley, other than I think there's a professional soccer player that's listed there. So yeah, if you find the professional soccer player, go to the other guy. Yeah, you'll see my picture there. CFA, CAIA. Love to connect with you and cover a number of different subjects, whatever you want to talk about.
Okay, great. Well, and we'll include a link to the website and also to your LinkedIn profile in the show notes for this episode when it goes live. Chris, thank you for coming on to the show today.
Well, Mo, thanks for having me. I mean, I love this stuff. I mean, some of it can get long and dreary, but it's all important, especially now that people are a little bit more focused on alts. It's, I've been spending a lot of time trying to get education and thought out there. So I appreciate the opportunity to coming in and talking with you.
Yeah, definitely. Thank you for coming on. And like you said, because the alt space continues to grow, that's one of the major reasons, or it's one of the big reasons why I reached out to you to have you come on and to kind of do this 2-part series to kind of help people out there when they're doing due diligence, when they're trying to figure out, what am I looking for? What am I supposed to be doing? So hopefully this discussion and the next one that we do kind of provides a good roadmap and foundation for people out there when they're doing due diligence.
I hope so. Yeah. And I look forward to the next discussion when we can dive a little bit deeper.
Yeah, definitely. I really appreciate you sharing your insights with the audience today, Chris. And that's all for today. Thank you everyone for tuning in. And until next time, have a great week.
Thank you for tuning in to this week's show. If you are interested in learning how alternative investments can help you build purpose-driven wealth, sign up on the High Rise Capital website to receive our monthly newsletter and free investor ebook. Lastly, if you enjoyed this episode, don't forget to subscribe and leave a 5-star review. Thank you for listening to Purpose Driven Wealth, the podcast for empowered investors.